This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. Of course, on the weekend we like to come back and re-examine the base case hypothesis and check to see if things are largely speaking still going according to plan. So today is not different. We're going to run through this thing from the top and check to see how much has changed, if anything. So let's get into this. The base case at the lows was we were too bearish, have a blow off top to all-time highs and come tumbling down in a global recession, a bear market, and have a deflationary component to this for a couple of months. We've done a pretty good job on this channel, I think, of trading this thing on the way up publicly, showing the stop losses on the way as always, using temporary third angles to exit into local tops before drawdown occurs. And so we're continuing to do that. You're probably going to see me exit my long in the not too distant future. When we get to the chart section at the end, I'll show you the live positions and stop loss levels as always. But I think this trend line that we've got here is going to represent a good opportunity to sell, take some profit, wait for a more significant correction, and then we can talk about getting back in at the next cycle low, setting a more reasonable second angle of attack before hopefully that third one comes in thereafter. So if you've been here a while, you know, same stuff over and over and over again, but it works. For Bitcoin, the idea is kind of simple, but I think we have to start to admit there's some complexity here. The idea is that these weekly cycle lows are extremely consistent, and out of each one of those weekly cycle lows, we have seen approximately a double from the low to the ultimate peak before we then correct into the next weekly cycle low. And really, this has been going according to plan. However, like I said, there's a little bit of complexity here because I think we have to have a little bit of an uncomfortable conversation about this, right? There's still time. It could be a number of weeks where we just see big green candles, we make it up to around 150k, and thus we get the double off the approximately 75k low, and nothing is out of the ordinary there. But something I did want to point out, okay, is that we've wasted quite a lot of time in this current bull phase of the weekly cycle, and we haven't covered as much ground as is typical for the profile of the weekly cycles for this entire bull run. And the reason this is significant is because this is indicative of waning momentum here. Now, of course, we can undo this in a single weekly candle, okay? If this week's big green candle takes us up above 130k, then fine, okay? We can forget about this idea. But the actual truth of the matter is, as we progress through these weekly cycles, especially if we're going to have a big parabola, we would actually expect them to start to yield more and more gains the later we go in the cycle, okay? Obviously, the gains from, say, here to here in a weekly cycle are significantly less because the trend angle is shallower, versus here to here in a weekly cycle, we would expect to make a lot more gains because the trend angle is much steeper. And so with that simple principle in mind, since we are allegedly, okay, forming a big parabola and a big blow off top, then during the last weekly cycle or the last two weekly cycles, we would actually expect to see more gains than we have seen in the prior weekly cycles. And at the moment, that's not what we've got. Instead, what we've got here is so far less gains than the prior weekly cycles, and it's taken a fair amount of time to do those less gains. So to me, it kind of says that we really need to see some big green candles here in the next couple of weeks for this to continue to be what I would consider operating as completely normal and to be expected. But if what happens here is we kind of trade sideways and then head for a weekly cycle low, I would suggest the underlying momentum in the market is actually not in line with the expectations of a typical parabola or a blow off top here. So to be clear, we have no idea yet, okay? Nobody really knows. And again, as I said a million times, but it is important. It could only take one or two big green candles to completely undo all of my concern here. But what we can see by looking at the profile of the weekly cycles is we went 94%, okay, approximately a double, 98%, approximately a double, 90%, approximately a double, a little bit more this time, 120%, okay, that makes sense. But then, like I said, if we really are in a parabola, this should be more than 120, and then the following one should be more than that. In the 2017 cycle, for context here, we saw 150%, okay, 150, 150, and then 150 again-ish, okay, plus or minus a few percent, of course. But by the time we got to this weekly cycle, in 2017, we then did 250% before doing something like 500%. Now, I'm not suggesting, I was never suggesting we would see a 250% followed by a 500%. That would take us to about $1 million a coin. So needless to say, that was not a call or an expectation on this channel, but you can see that by looking at the 2017 cycle, we kind of went consistent gains, consistent gains, consistent gains, once again consistent gains, then we got more gains than all of the priors, and then we got even more as we enter that final vertical blow off top portion. And again, that is consistent with the expectations of a parabola. Yeah, When the trend angle is shallow, it makes sense that the gains are pretty consistent. Once it enters the next angle of attack, we start to make more and more gains until ultimately when we're going vertical, we can cover insane amounts of ground very, very quickly. But for all of that to continue to be observed here, for all of that to continue to be the case for Bitcoin, we really do need to see some big green candles here. And of course, if instead what we get is trading sideways and down into a weekly cycle, then to me that would be more indicative of a rollover and a total trend change here. It wouldn't really look anything like you would expect a parabolic blow off top to look, because the observable trend here would be consistent gains all the way through, only to go lackluster, less gains. That to me would be indicative of waning momentum, a rollover, and ultimately a trend shift. So not something I want to see, of course, not something I think anyone wants to see, but objectively speaking, this is now getting to that stage where, again, if we don't see some big green candles, then we do have to entertain this as one possible scenario. Of course, it's always possible as well that we kind of roll over here into a weekly cycle and then we go pretty much vertical. That's entirely possible too. Anything and everything is on the table all the time. And as ever on this channel, we're going to keep taking it one day at a time and do our best to stay on the right side of the trade, irrespective of what happens to the price. So as I said at the start, I believe this bear market, when it shows up, is going to have a deflationary component to it, which of course brings me on to the next component of this hypothesis, and that is that anything you do to the M2 rate of change shows up in the inflation data, albeit with a lag. Since we went down, sideways and down, I've been hypothesizing this would happen in the CPI data, the inflation data, and we would ultimately slip into deflation for a short period of time. For an updated look at this chart, I don't think anything is out of the ordinary there. And whilst, again, investors have a very bad habit of zooming in and looking at just short periods of data and then jumping to conclusions and saying things like, there you go, inflation is sticky, the bottom's in, all that kind of thing. When we zoom out, the trend is very much disinflationary. We continue to make lower highs and lower lows the whole way down. This is probably yet another lower high, and then off we go to new lower lows. So the trend is still disinflationary. We don't invalidate this idea until we make new highs, which I really don't think is likely, to be completely honest with you. We're also seeing this confirmed in the last couple of weeks with the CPI print, with the PPI, which is at 0% for both headline and core month over month. Note the shape of the inflation trend, down, sideways, getting ready to go down before ultimately slipping into a short period of asset price deflation. So as ever, we're going to continue to tick that one off until invalidation is hit. And therefore, I maintain we are still in a disinflationary trend and heading for a short period of asset price deflation. Over in the jobs market, we continue to get a lot of wobbles, a lot of complexity, a lot of conflicting data points. And as if that's not enough, we're also experiencing a great deal of revisions to the data sets, making navigating this whole labour market quite a pain, to be completely honest. The initial jobless claims came out this week, slightly lower than expected, as were the continuing claims. But as I was saying with the inflation data, if we zoom out and look at it in totality, it is still trending towards deterioration in the labour market. We know things like ADP private payrolls have been tanking. We know this Piper-Sandler recession indicator that Henrik likes to use is really starting to show the early warning signs before a big spike, which is synonymous with entering recessions. So it still seems like we're moving in that direction. It's just taking a very, very long time, but we haven't yet really been able to undo the work here. We haven't been able to undo the damage and say to ourselves, okay, we can definitely rule out a recession yet. Now, of course, that could happen over the coming months. We would need to see consistent and persistent back-to-back improvements in these data sets, but at the moment, we just don't have that. Furthermore, it is also true the parallels to 2007 in terms of these kind of macro data sets are objectively observable. Okay, back in 2007 in June, no one was ringing the alarm bells. The Fed was apparently in control of a strong economy. Meanwhile, they had an inflation rate of 2.7, right? Unemployment at 4.5, NFP at 132k, ADP at 115k, and the Fed funds rate at about 5.25%. Meanwhile, today, we've got an inflation rate at 2.7, unemployment rate at about 4.1, and it was, of course, 4.3 just one print ago. Again, it speaks to this idea of nominal improvements are showing up, but they need to persist over time and continue to trend in that direction to actually undo the possibility of large spikes synonymous with recessionary periods. NFP at 147k, about the same as back in the 2007. The ADP significantly lower, and the Fed funds rate not far off. And once again, we've got the Fed, economists, the media, etc., all convinced that everything is fine and the economy is going to continue to grow. But there have been many warning signs, especially in the housing market, of a severe slowdown coming in the not too distant future. So at the moment, whilst everything seems okay, whilst there has been some nominal improvements in the data sets, when we zoom out and look at the totality of the data, it is still trending towards a recession, albeit it is taking a very, very long time. And of course, it's easy to get distracted when we look at risk assets like the stock market and Bitcoin, which are just blasting to new highs relentlessly. Every dip gets relentlessly bid up. But remember, the markets are not the economy, and that is an important distinction to make. Very similar concepts apply to the U6 data. We've had a couple of, again, nominal improvements, okay? This looks something like this. As you can see here, we had a couple of prints at 7.8 and then one at 7.7. So a touch better, but still nowhere near enough to say, okay, we swerved the recession, there's no risk of a big spike like this, which again is conducive to recessionary periods. The exact same is true of the SAM recession rule. I think by next weekend's deep dive, we should have a new updated print for this. So it'll be interesting to see if this is nothing more than one lower print that will ultimately start to resolve to new highs, in which case, again, I think alarm bells can start to be ringing here, or perhaps what we can see is consistent back-to-back improvements, which would give us some signs of relief that potentially we can swerve a recession here. At the moment, there is absolutely no chance of seeing a rate cut at July's meeting at the end of this month, but we are currently in favour of having seen a rate cut by September. So it will be interesting to see if this continues to persist or whether we will reprice this in favour of remaining paused. I'm still making the case the Fed is overly restrictive given how far behind the inflation curve it is. We're already at target for inflation. Since the Fed is not targeting 2% CPI or PPI, it's targeting 2% PCE, which historically is approximately equivalent to 2.5% inflation. So they've already tamed inflation. The inflationary trend is still disinflationary, as we come here and show every single weekend, and the labour market deterioration has not shown any signs of improvement just yet, other than one or two prints, but nothing consistent or persistent. And therefore, I still maintain that this is overly restrictive and it's ultimately going to have a pretty severe impact when eventually this policy catches up to reality. It's also a super weird time to be alive because we can see that the president is kind of hunting the Fed chair. He's trying to accuse him of things and overspending and all this kind of thing. But really, I think whether or not he resigns, whether or not he ends up being fired, I think he's done his job. I think he was put there to keep monetary policy overly restrictive, to organise this controlled demolition. And it seems to me like every week we come here, we are nudging closer to that controlled demolition. So since his job is done, I think it's pretty much time for him to bow out. I'm not sure what narrative they'll use to explain him leaving. I'm not sure how long it will take for him to walk, but I'm pretty sure by the end of this year, we're going to have a different Fed chair and someone else to use as a scapegoat for blaming the collapse and recession on. The last couple of things we look at are the high yield credit spreads. And once again, we've been talking about coming back below the breakout level and ranging below the trend line. But in doing so, okay, then this should be conducive to higher risk asset prices over the coming weeks and months. And so far, that's what we've got. So it's this weird dichotomy of having an economy that is very clearly heading into a recession, very clearly deteriorating in real time, at a time, I might add, where many economists, the media, traders, investors, speculators, all seem to think that the risk of recession is pretty low. That seems to be my observation. I don't think many people are seriously entertaining this as an idea. Whilst at the same time, we've got the stock market and risk ripping higher and a bunch of data supporting that it can continue to rip higher for longer. So we've almost got this K-shape going on where the markets are ripping higher and the economy is slowly moving lower, which I suspect can continue for a while longer. I think it's probably going to take a good few months for the top to come in for the markets. And I also think it's going to take a good few months before this economy starts to get to the deterioration point where we have to accept. And when I say we, I mean literally everybody is forced to accept that we are indeed in quite a severe recession. And similarly to the high yield credit spreads, we also look at the yield curves and use these as an alarm signal for any kind of breakdowns in the markets should they occur. Something investors get wrong all the time is when this thing inverts, when the yield curve inverts, they jump up and down and scream recession, and they're wrong. When it reverts back above zero, they jump up and down and scream recession, and they're wrong, because it is the acceleration in the weekly price action that is synonymous with tops coming in for the stock market. And when we zoom in here to get an updated look at this chart, what do we see? Yet another week of sideways price action in the 10-2 yield curve. So remember, sideways is good, it's conducive to bullish and risk on action in the markets. Down is fine as well, okay? Also conducive to bullish upside momentum. It is only the accelerative sweeps to the upside, just like we saw back here in the C19 plunge, just like we saw back here in the GFC, and just like we saw back here in the dot-com bubble that are synonymous with tops coming in. At the hard right edge, we don't have that for many weeks now. In fact, since about April, we continue to just trade sideways and almost look to me like we are thinking about heading lower. So happy days, right? Again, fits with the idea that the markets can continue to be risk on for a while longer. We can sharpen this curve by changing the 2-year yield to the 3-month yield. And this signal, once it starts to make accelerative sweeps, again, here's the one from the C19 era, here's the one from the GFC, and here's the one from the dot-com bubble. Once those accelerative sweeps are made in the 10-year, 3-month yield spread, you have even less time to react. But when we zoom in at the hard right edge, have we got anything to be concerned about? Doesn't look like it yet, does it? It doesn't look like any kind of big green candles on the weekly time frame. Doesn't look like it's thinking about making an accelerative sweep to the upside, which again is conducive to higher risk asset prices over the coming weeks and months. So again, the challenge remains here. Can you hold these two opposing views in your mind simultaneously? Can you be bullish and long risk until such time as you have reasons to not be, whilst also acknowledging the fact that the macro data set, the economy in aggregate, continues to get slowly worse over time? And so since everything looks conducive to higher prices so far, it's not surprising that we are long with a public stop loss level as always. Level 3 members notified in real time with the exact level for entry and stop loss as always. And so far this thing just continues to push, doesn't it? We didn't even really get a flush for a cycle low here. We formed a timing based cycle low. If I turn this on, you can see that we've got our cycle lows, and it seems like this thing wants to push higher. The momentum is enough for the indicator to tag this with high confluence instead of medium or low, which tells me on a balance of probabilities we're going to be ripping higher in the not too distant future. So again, we continue to trade in and out of this thing in front of everyone. We continue to set trend lines to let us know when to exit the market, but so far there's no reason to do so. So long and strong continue to push there. Notice how the VIX has closed the week on a 14 handle as well, okay? This is not nothing. It's very, very, very conducive to having that final blow off top moment into the ultimate top for the stock market. Long-time viewers of the channel will know we've been targeting sub 12 for what we've been kind of joking around calling a generational entry. I'm not really one that believes in these kind of generational entries or anything like that, but I do think that by the time we get to sub 12, it's going to be a case of hedge when you can, not when you want to. Gold, to me, looks like it's very nearly completed its consolidation before a big rip-roaring move higher. We've been positioned for this, trading this thing the whole way via things like gold, silver, and the miners and mining stocks. We're a little over halfway through this cycle now. Oh, in fact, we're very nearly through this cycle, so anywhere in the next 6 or so sessions should yield another cycle low to complete this huge correction, and then I think it will be time to rip higher for the final move to the top before we're going to top in the metal markets and start to head for those half cycle lows in the 8-year cycles. So very, very bullish here, gold. Just think we need to chop around, find one more cycle low, higher low, and go, and then it should be party time for the precious metals. And of course, we've been capturing this thing again in the level 3 member section via things like SILJ, which you've got multiple positions stacked up, and I expect this thing to be a lot higher. For Bitcoin, as I was saying, you know, so far not that bad, but we are kind of running out of time here in the profile of this weekly cycle since back here to get to that kind of double, or hopefully what would be slightly more than double, before we can then correct and head into the next weekly cycle low. Now it's Bitcoin, okay, Bitcoin can and often does do Bitcoin things. It likes to convince people it's never going to pump again or that it's topped, only to then we wake up the next day to a huge big push to the upside. So something like this doesn't seem impossible to me. I think we can get this done cycle low and then head for a weekly cycle. All would be normal. I don't really think that's impossible, but again, we do have to acknowledge that if what comes out of here is kind of more and more sideways action, then it is going to be quite difficult to cover the amount of ground that we need to be able to maintain that parabola and that blow off top look for Bitcoin. So far though, I don't think there's anything to be concerned about just yet. I think we should give the market the benefit of the doubt. We're certainly still in an uptrend. It's still a strong uptrend for now, at least. We're still making many higher highs and higher lows, and a bunch of those crypto stocks as well are also doing extremely well. Things like Riot is another one we added in the level 3 member section, continues to push, doesn't it, right? With a big breakout of this huge purple resistance line that goes all the way back to July of 2023. So it seems to me like we're in the final innings. It seems to me like the institutions that are driving these kind of stocks are well aware of what's going on under the hood and are getting ready to blow these things off into the final highs towards the end of this year. Again, speaks to a lot of risk still available to be captured whilst the economy continues to move towards recession. And I think it all fits from a longer term cycle perspective too. By the time we kind of have these big squeezes, assuming we can get them, we'll be late in this year. We'll be looking to exit the markets, target those 4-year cycle lows. And by then, I think every man and his dog will have worked out that we've probably been in a recession for longer than most people wanted to admit. Also notice where we are as well in the cycle, the proliferation of these ideas that there are no more 4-year cycles, that there will never be another bear market. All of this kind of thing is starting to proliferate, just as we expected, just as we've been calling for a very long time. So right on schedule, okay, the crew continues to show up. They continue to start to regurgitate these silly ideas simply because they do not understand how cycles work. They just throw around the terms without actually knowing how to define them. But that's okay, because we're the Camel Crew and we understand the cycles, and we're going to continue to do what we always do on this channel. So I'm your boy Camel. I hope you're doing well in life. I hope you found some value here today. If you're a level 3 member, look out for the members only update I'm going to post for you guys today. And other than that, I'll be back on Monday. Have a fantastic weekend. Until next time, all the best from me. Cheers. Bye.
Camel finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns and his money